Australians are borrowing more than they ever have as the banks fight for their business. But have they taken on too much risk? Today, the banking regulator said that Australia's banks are not only too big to fail, they're too big to even look shaky. But the regulator's own secret research, obtained by 7:30, shows just how shaky the banks were looking before the global financial crisis. Lending standards were so lax, the banks faced the risk of a massive and unprecedented rise in the number of people defaulting on their loans. Experts say it could have caused an economic meltdown. And yet instead of that being a wake-up call, as Stephen Long reports, today the problem is far worse.
In 2006, property was booming and lending was free and easy. Rob and Jennifer Cleary took advantage of the easy money to buy a home by the water.
It was my dream home, yeah. Yeah, it was my dream home. I always wanted a waterfront property with a wharf.
ANZ Bank lent them a cool $1 million. How did you feel when they lent you that money?
I was stunned, surprised and stunned. I hadn't really expected for it to happen.
Stunned because the bank knew they already had colossal debts.
The liabilities that we had at the time were $1 million on one property with the ANZ, 1.2 with another organisation, and 62,500 in credit card debt.
So that was all disclosed, $1 million loan with ANZ, 1.2 million with someone else, and 62,500 in credit card debt.
Yeah.
A grand total of $3.25 million in debt after the loan for their dream home. A mortgage broker filled out and submitted 2 loan applications for the self-employed couple, one in both their names, one in Rob's alone. ANZ didn't worry that the application stated significantly different figures for Rob's monthly income. The Clearys got their $1 million with zero proof of earnings on a low-doc loan.
It seems pretty crazy, the amount of money they were willing to fork out.
Yeah, well, the whole atmosphere was crazy. The whole atmosphere in 2006 was crazy. The property market was booming. People were paying hand over fist for property values, as they did last year.
But in those heady days before the global financial crisis, the banking regulator was worried, especially about a shift to lower lending standards that was letting the banks lend so much money that after repayments, people were living somewhere near the breadline. The ABC has obtained research that the banking regulator APRA carried out back then. Its conclusions are alarming. A homegrown recession from lax bank lending standards.
Yes, that would be the conclusion from the APRA paper. There's probably no doubt that Australia would have had a recession, increased mortgage defaults, increased unemployment, borrowing costs going up, and real pressure on the economy.
The banking regulator never made public the extent of its concerns, but its secret report found that by lowering lending standards, the banks had been able to issue nearly 3.5 times as many loans as they otherwise could have. But under the new lending standards, about 14% of the loans weren't serviceable when they were approved. APRA forecast a massive and unprecedented rise in the number of people who couldn't make their home loan repayments, with a 7.5% home loan delinquency rate in September 2009 if the economic environment remains unchanged.
As it turns out, dodgy lending overseas caused a global meltdown. The Reserve Bank slashed interest rates, the government threw money at households, and a homegrown banking crisis caused by lax lending was averted. The irony is that the global financial crisis actually saved us in Australia in some senses.
In some senses, you could say that. Or were we actually just delaying the problem and not fixing it?
The GFC may be behind us, but there are many who fear Australia's banks haven't learnt the lesson from that crisis. While incomes stagnate, household debt has soared to new records. Household debt in Australia is now bigger than the entire annual output of the economy, the highest level in the world.
Mortgage debt has almost doubled since that report was written. Therefore, the problem is much, much bigger.
Look, I don't believe we are going to have a crisis, and nor do I believe we've got any lax lending standards. It is true that in Australia we do put a lot of our savings into our homes. That's been a long-standing situation, and we do have high house prices in Australia. But that's something that's monitored very closely by both the banks and the regulators.
There's no doubt about it at all. Australian households are massively indebted. And one of the things...
Veteran bank analyst Brian Johnson is not predicting a crisis, but he is very concerned by recent research from the banking regulator, which says that if there was a house price crash, Australia's biggest banks wouldn't have enough capital to cover losses on mortgages.
As I actually read the speech that APRA actually made, I've got to say it was probably one of the most disturbing things I've ever read. What they said was that the standardised banks, which is basically the regional banks, just passed. They said that the advanced banks, which is basically the major banks, that they said that they did not pass.
They failed the stress test.
Well, I would say did not pass means failed, but apparently I've been instructed by one of the banks that's not what it means, but it sounds like that to me. Did not. If my child came home and said I did not pass, I would say that means you failed.
APRA Chairman Wayne Byers admitted at a Senate committee last year that a further erosion of bank lending standards in recent years had caught the regulator unawares.
We were a bit surprised by how much the competitive pressures in the industry and the competitive dynamic in the industry had led people to do things that were, really, in our view, lacking in common sense.
The banking watchdog is now fighting a rearguard action to rein the banks in, demanding that banks raise more capital, curb investor housing loans and tighten lending standards. The banking regulator declined our request for an interview, but a senior official said today that it was a significant concern that the Big Four banks were so exposed to home lending.
What happens to all the people who've taken on huge mortgages when interest rates are at historic lows if interest rates go back to normal?
They won't be able to service them. There will be wholesale defaults.
Rob and Jennifer Cleary defaulted on their $1 million home loan after the GFC hit and their small business hit hard times. The value of their waterfront home collapsed from $1.4 million to $900,000. They were forced to sell it, and a property the family had owned for more than 25 years at Dural. The Financial Ombudsman Service said that ANZ was likely guilty of irresponsible lending, but it couldn't help the Clearys because the loan was above its $500,000 limit. The bank offered a small settlement anyway.
Describe the bank lending standards at the time.
Slack. I think that sums it up. That was very slack.
It was very easy.
It was too easy for us.
Had the lax lending standards of a decade ago played out the way the banking regulator feared, we could have seen a banking crisis back then. Was it prevented or just delayed?
There's a number of settings with interest rates and offshore lending that effectively could hold the market up for quite some time. But it's unimaginable that it can hold it up forever or for any significant period of time.
Stephen Long reporting.